Hello and welcome. In this lecture video, we'll continue with talking about bond pricing, do a few more problems, and then also talk about the journal entries for paying off, otherwise known as retiring bonds. Okay, so we did this problem on ending last lecture video where we went through and we calculated the selling prices approximately correct using the present value tables. I want you to do something similar, the same exact table for this problem to get extra practice. And then what I also want you to do is do this problem on the prior page that talks about how to issue bonds at a discount or premium, and then also the journal entry for the interest payment. This is just extra practice, okay? So go ahead and pause the lecture video, and then we'll start by reviewing this problem and then the problem on the next page with the Sanchez company, going over that one, okay? So pause the lecture video, complete these independently, and then restart it, and then we'll check your work. Okay. Okay, welcome back. So let's see how you did. So on December 31st, a company issues 16% 10-year bonds with par value of $100,000. Interest is paid semi-annually, which you can tell June 30th and December 31st. The bonds are sold to yield 14% market, an issue price of $110,592. Is this a premium or discount bond? This is premium because contract rate 16% is greater than market rate at 14%. The second one, prepare the journal entry to recognize the second interest payment. The second interest payment is going to be the same as the first because it's using the straight line method. It's going to always be the same with the straight line method, so it just does not matter. So we have to calculate our bond interest expense, and so to do that, we have to first figure out how much cash do we pay our bondholders. Par value times contract rate. Par value times contract rate. Contract rate is 16%, but it's semi-annual. So it's 8% because it's $8,000 minus the amortized premium. The premium is $110,592, which is the price of the bonds, minus the $100,000 par value divided by 20 because it's 10-year bonds, semi-annual. So 20 total periods, $529.60. I take the cash to my bondholders because this is a premium. Cash to my bondholders minus my premium amortized gives me my $7,470.40. Then my journal entry is debit to bond interest expense, debit to the premium, which we just calculated, credit to cash $8,000. Okay, so I hope you got that right. Let's look at the problem on the next page, which was similar with the Sanchez company problem, which is similar to our other problem with Alberto company. So what we do, remember this, what this is telling you is that these bonds are trading at 117.25% of par value. This is par value. So to figure out what the price would be on the markets, right, I take my 120,000 times 1.1725 gives me my 140,700. And then to use the present value tables to make sure it's approximately correct, like what we did up here, I set up my cash flow, my factor, cash flow times factor equals present value. This is my par value. So my first cash flow is my par value. Par value, this is present value single amount table. I got this from the present value of single amount table. 30 periods, and then 4%. 30 periods, 4%, because we have to use the market rate of return as the discount rate. And this is annual, so it's 4% every 6 months. 30 periods, 4%, this is the factor. Cash flow times factor equals present value. And then the next thing I actually have to do is figure out, well, what is the cash payment to my bondholders? And we know that is always par value times contract rate. Par value, my contract rate is 10% per year, which means it's 5% every 6 months. So that gives me that $6,000 right over here. And then I look up in my present value of an annuity table, I find my factor. This is my factor from the present value of annuity table. 4%, 30 periods. This is my factor, 17.2920. 6,000 times 17.2920. This is the present value of my future interest payments. This is the present value of the par value. I add them together, 147.48. It's off by $8. Why? It's a rounding issue. Okay? It is approximately correct. All right, so let's take a look at retiring bonds. Okay, retiring bonds. So retiring bonds is a fancy way for saying we're paying off the bonds. Okay, so if we hold them to maturity, which is when they're due, then the journal entry really isn't very complex. It's like paying off any other liability, where we debit the liability and then we credit cash. Okay, so if we look at this example, retirement of our bonds at maturity for $100,000 cash, what would be the journal entry? Well, I'm paying off my bonds payable. So remember, when I issued my bonds payable, in terms of my T accounts, remember I had that $100,000 right there. That's when I issued. So if I want to zero out the bonds payable liability account, put $100,000 on the debit side. What do I pay it off with? Cash. Cash is an asset. How do I reduce an asset? Because cash is going down. Our cash is going down. So assets are going down. I reduce an asset with the credit. So my journal entry is debit bonds payable, $100,000, credit to cash, $100,000. That's my journal entry. Okay? So that's the easier one. The harder ones are, well, what happens when you retire the bonds before maturity? Okay, so you basically pay off the bonds before they're due. Why would a company want to do that? Why won't they just wait to maturity? They certainly could, but there are some other reasons why a company might want to do this. And the first one is, what if when they issued the bonds, they issued their initial bonds with a contract rate of 8%. And that was 3 years ago. So 3 years ago, they issued $100,000 worth of bonds at 8% contract rate. But then the Federal Reserve cut interest rates pretty recently, which lowers all interest rates. Okay, so what they could do is they could retire the bonds early, reissue them at 4% or 5% or whatever the interest rate is, whatever the lower interest rate would be. So they may want to retire those bonds early and then reissue them with lower interest bonds. So it'd be kind of like you paying off one credit card with one higher credit card with a lower credit card rate. Something like that. It'd be the same idea. You're going to replace your high interest debt with lower interest debt. Okay? So there's a couple different ways that a company could do this. How could they actually go through and do this? There's two different ways. The first one is they could go out onto the open market, onto the exchanges, and purchase their own debt. The second one is that they could exercise a call option. So when they issue the bonds, they can issue the bonds with a call option. What is a call option? It's a provision that allows that bond issuer to retire debt at a specific price. Okay? So in that case, when the issuer wants to retire the bonds earlier than maturity and it has a call option, they want to exercise the call option, they're going to pay the par value plus some premium. Now, why does the bondholder, the person who's buying the bond, why do they want a call premium? Because they're going to say, well, if you're going to pay it off early, right, you're going to pay me my money early and I don't get any more interest payments, I want to be compensated for that. Okay? So if the company purchases their bonds on the open market, they'll pay the market price. Now, it's very unlikely that the issuer will pay a price exactly equal to the carrying value of the bond. So remember the carrying value of the bond. With a discount, it was the par minus the unamortized discount. Okay? the par minus the unamortized discount. That was carrying value for a discount bond. What is carrying value for a premium bond? Par plus unamortized, and I'm just abbreviating unamortized premium. Okay, so that's the carrying value. So it's unlikely that they're going to pay the price that they'll pay is exactly equal to the carrying value. So when there's a difference between the carrying value and then the price that the company pays to retire that debt early, there's either a gain or a loss. And this is a gain on the income statement, similar to revenue. This is a loss on the income statement and another expense. Okay? So when the carrying value is greater than the retirement price, we have a gain. When the carrying value is less than the retirement price, this is the price that the company pays to retire their debt. This is either par minus unamortized discount or par plus unamortized premium. When that carrying value is less than the retirement price, we have a loss. When it's greater, we have a gain. Okay, so let's look at our example here to really walk through this. Assume that $100,000 of callable bonds will be retired on July 1st after the first interest payment. Okay, the bond carrying value is $104,500. Okay, these have a premium of $3,000. So when I see this call premium, what does that mean? The issue will pay to the price that the issuer is going to pay in this situation is par plus the call premium. That's the price that the company is going to have to pay to retire their debt, which you can see right now is going to be our $103,000. Okay, so let's talk about this journal entry. So when we come over here and we think about this in terms of our T accounts, we have our bonds payable. Remember when we issued it, we had $100,000 over there. So when we retire this debt, we know for sure we're going to debit bonds payable, because then that zeroes out the bonds payable liability account. So I'll debit bonds payable for the par value of $100,000. And then remember what we have, and we can see the carrying value is $104,500. What is this telling you? This is telling you that these bonds were issued at a premium. So we have this premium over here on bonds payable, and that's $4,500. That's the unamortized premium so far. That is the unamortized premium. How do I know that? Well, look at the par. The carrying value is greater than the par. The only way that can be is that these bonds were issued at a premium. So if I want to zero out the premium on bonds payable, the normal balance as a credit, how do I do that in terms of debits and credits? I'm going to debit it, because if I put $4,500 there in the debit column, now my balance in my premium is now zero. So I'll debit my premium on bonds payable, $4,500. And then what I do, I have to pay cash to retire these bonds. So I'm going to pay off these bonds earlier. And what am I going to pay off the bonds with is cash. How much cash do I have to pay? Well, remember, if we look up here, it has that call provision. That means the issuer is going to pay the par value plus the call premium. Par value plus the call premium. So we have to pay $103,000 cash. Okay? We're almost done with our journal entry, but we're missing one thing. Gain or loss. Okay? Now, if we look over here, we can say, look at our carrying value versus our retirement price. 103 is our retirement price. What is our carrying value? 104,500. Therefore, we have a gain because the carrying value is more than the retirement price. Gain on bond retirement equal to the difference between the price and then the carrying value. 103 minus the $4,500 gives us the $1,500. Okay? All right, so I'm going to end this lecture video. In the next lecture video, I'll do one more problems on retiring bonds and then talk about installment notes and then the effective rate method. Okay, thanks so much.